This video is about capital gains tax planning at the end of the tax year 2022-23. So we will look at what is capital gains tax, how is it calculated, what is changing, and we will give you 5 top tips. So what is capital gains tax? When you buy an asset, say shares or property, and sell it at a higher price, you pay tax on this one-off gain you make. This is capital gains tax. For example, say you buy a property for 100,000 and sell it on at 130,000. In this case, you make a gain of 30,000 and there would be capital gains tax payable on this. How is it calculated? The gain is the difference between your purchase price and your selling price. In the earlier example, this is 30,000. You can also deduct any buying or selling cost and any capital expenditure you made. Let's say you paid 5,000 in buying selling costs, including estate agents' fees, legal costs, etc. So your gain in this instance is 25,000. The annual exemption is deducted before determining the taxable capital gains. For individuals, the annual exempt amount is 12,300 for 22-23. So we take away 12,300 from your gain of 25,000 and your taxable gain is therefore 12,700. Taxable capital gains are added to your other taxable income in order to determine what rate of CGT you will have to pay. As long as you remain within the basic rate tax band, your capital gains will be taxed at 10%. For any gains that exceeds the basic rate tax band, your capital gains will be taxed at 20%. There is a twist in this though. If these capital gains are linked to residential property, then your capital gains will be taxed at 18% and 28% rather than at 10% and 28% and 10% and 20%, sorry. What is changing? So remember we talked about annual CGT exemption, which is 12,300 in this tax year. Well, this annual exemption for individuals will reduce from 12,300 to 6,000 in 6th April 23 and to 3,000 from 6th April 2024. And after that, moving forward, is going to remain at 3,000. So here are our top tips for effective CGT planning. Tip 1. Using the annual CGT exemption. As the CGT annual exemption is reducing from 6th April 23 onwards, a key focus of the tax year end planning for CGT this year will be reviewing any unrealized gains in investments and considering whether to use any of these to ensure that you fully use your 12,300 annual CGT exemption. For example, if you have shares portfolio that is pregnant with capital gains, you may want to realize some of that gain before the tax year ends in order to fully use your annual CGT exemption. If you're a basic rate taxpayer, meaning you earn up to a maximum of 50,270 and hence fall in the 20% income tax bracket, the tax saving could be worth up to £1,230 for you. If you are a higher or additional rate taxpayer, meaning you are in the 40 or 45% income tax bracket, then using your full annual CGT exemption in this year can save you up to 2,460 in tax. As far as possible, it is important to use the annual exemption each tax year because if unused, it cannot be carried forward. The government's attitude with regards to annual CGT exemption is use it or lose it. If you don't regularly use your annual exemption each tax year, you are more likely to reach a point in future where some of your gains will be subject to CGT. In order to use your CGT annual exemption, however, you can't just sell and then immediately repurchase an investment. This is referred to as bed and breakfast planning. If you sell an asset, you must not personally reacquire the same asset within 30 days of disposal. However, there are other ways of achieving similar results. For example, bed and ISA. An investment can be sold, example, units in a unit trust or shares in a open-ended investment company and bought back immediately within a tax-efficient ISA wrapper. For this tax year, that is 22-23, the maximum amount you can contribute to an ISA is 20,000. This remains at 20,000 for 2023-24 too. The other way is bed and pension. Similar to ISA, you can sell the units in the existing investment and repurchase them through the pension. This approach has the added benefit of income tax relief on the contribution. Besides, the maximum contribution limit for pensions can be much higher than an ISA. Of course, it depends on your earned income and other pension contributions. Other method is bed and spouse. One spouse or civil partner can sell an investment and the other spouse or civil partner can buy the same investment without falling foul of the rules against bed and breakfasting. However, the sale of the investment cannot be to the other spouse or civil partner. The two transactions must be separate. The other way is bed and something similar. Many funds have similar investment objectives. So, for example, if you were to sell units in a UK Growth Fund A and buy units in a UK Growth Fund B, the nature of the investment in the underlying shareholdings may not change much. But because the fund providers are different, the transactions will not be caught by the rules against bed and breakfasting. Tip 2. CGT planning for spouse or civil partners. If you were to transfer assets into your spouse's or civil partner's name before these assets are disposed of, you could benefit from two lots of annual exemptions. This way, jointly, you can release capital gains of 24,600 this tax year with no CGT to pay. You can do this by an outright and unconditional lifetime transfer from one spouse or civil partner to the other. This should not give rise to any inheritance tax consequences or any CGT implications provided you and your spouse or civil partner live together. Indeed, if your spouse or civil partner is a basic rate taxpayer and say you are a higher or additional rate taxpayer, it may even be worthwhile transferring an asset showing a gain of more than 12,300 if the asset is to be sold. This is because now the surplus capital gains will be taxed at 10% rather than 20%. Of course, care should be taken not to fall foul of the CGT anti-avoidance rules that apply, meaning money or assets must not return to the original owner of the assets, showing the loss. Tip 3. Pension contributions to reduce the tax on the capital gains. If your taxable income at the moment is using almost all of your basic rate income tax band, say your total income is just under 50,270, then the taxable capital gain will take you into the high rate bracket. This means that most of your taxable capital gain will suffer CGT at a rate of 20%. By taking action to increase the basic rate tax limit, it is possible to save CGT. One way to do this is to pay a contribution to a registered pension scheme whereby your basic rate tax band will increase by the gross pension contribution. Example, a personal pension contribution where tax relief is given at source. You can achieve the same result by making gross pension contribution to your workplace pension scheme. Tip 4. Loss relief strategies. When calculating your taxable capital gains for a tax year, you must first deduct losses of that tax year, then the CGT annual exemption, and this will give you your taxable capital gains figure for that tax year. Loss relief can therefore be important, particularly if you are a higher or additional rate taxpayer and hence paying CGT at 20%. In this respect, the rules for losses depend on whether you have a carried forward loss arising from excess losses in previous tax years or a loss from the current tax year. For carried forward losses, you don't need to reduce the whole taxable gain. You can reduce just enough to use your annual CGT exemption and carry forward any further loss for future tax years. But same year losses that arise in the same tax year as a capital gains you've made, they are fully netted off against those capital gains to bring them down to zero. So excess losses will then become your carried forward losses. In circumstances where you're realizing losses in the same tax year as gains, you therefore need to be careful not to cause a part or all of your annual CGT exemption to be lost in the tax year in question. Tip 5. CGT deferral. If you're thinking of making a disposal in the near future, which will trigger a capital gain in excess of 12,300, it may be worthwhile, if possible, to spread the disposal across two separate tax years. For example, if you're looking to sell shares worth, say, 30,000, you can sell half of these before 5th April 2023 and the remaining half after 6th April 2023. This way, you can use two lots of annual exemptions. If you would like more information about this subject or wish to discuss your own finances, please get in touch with us using the details in the description. Thank you for watching.